Great. We're on air. All right, Becca.
All right, well, again, I'm Brian Newton. Thanks for having me out. I'm a partner with the McGowan, Hurst, Clark & Smith CPA firm. We're located out in West Des Moines. We also have a satellite office in Winnipeg, Iowa. We're one of the larger local CPA firms in town. We've been around for close to 75 years. You may have heard of us to see how well we're marketing. Here's kind of just a 5 bullet point agenda of what I'm hoping to get through this morning. Talk briefly about some best practices for any self-employed business people, business entity classification, tax deductions, some that are specific to realtors, some general reporting requirements, and last but not least, we're out with tax reform, the impact it might have on your industry, and with where tax reform is going, a lot of what I might tell you before may be short-lived. So just in general, best practices as far as how to operate your business, recommending having a dedicated bank account for your transactions, a dedicated credit card. If you ever get audited, they may focus on the business itself. You've got commingled funds in there that can just raise more questions than you may want to deal with. So again, always just a recommendation to have a dedicated account, a dedicated credit card to track all your business activity. Accurate and timely records and document retention requirements. We recommend a 7-year retention for most of your documents that include your 1099s for your income, if you have employees, your payroll records, receipts, all that kind of stuff, mileage logs. Even though there is a 3-year statute from the IRS, if they do find evidence of fraud or anything like that, they can go back beyond that 3-year period. So if you go to our website, we have a record retention guide that kind of lists all the what we recommend for all sorts of legal and business documents. And if you have questions throughout this presentation, just raise your hand and I'll do my best to answer them. Business entity choice. We primarily see 3 different varieties in the real estate agent market. Sole proprietor, you simply you put your name out there. There's no legal organization. Fairly easy to operate. You're just operating as yourself. All the activity is just reported on your 1040. Disadvantages of the sole proprietor is there's some personal liability issues. You're not protected by any corporate shield. And then there's a self-employment tax on your net income, which I'm sure you've all had to deal with come tax time. The next kind of step up from there would be a limited liability company of some sort, whether that be a single member, if it's just you. Essentially, it's the same as a sole proprietorship, except it does have some liability protection. Now, in your case, you're going to have errors and omissions, and you're going to have insurance to help cover some of that liability. And unless you're just negligent, no, they're not going to sue you personally anyway. So whether you need that layer of limited liability, probably not. The insurance will probably cover it for the most part in your industry. And then if you're in a partnership with other realtors, you can do a multi-member LLC, which would be a default to a partnership tax return. And then the third one that we kind of see with realtors is an S corporation. Is anybody in here set up using an S corporation status? Okay. So the biggest advantage of utilizing the S corporation model is you can save on some of that self-employment tax. So as a sole proprietor, basically 100% of the dollars of your net income is subject to the FICA and Medicare, your share and the employer share, so that amounts to about 15%. By incorporating into an entity, having your commissions flow through that entity, and then you take a reasonable salary out, you're only going to pay that FICA and Medicare on whatever your reasonable salary is. So there's a method to save some pretty significant tax dollars through the SCorp model over time. That being said, with what they're talking about with tax reform, who knows what they'll do with the S corporations and whether that self-employment, not loophole, but advantage will go away.
Is there like a particular gross income that you guys try to earmark, trying to set up a SCorp? Is there a certain amount of money that should come into the business to justify doing a subchapter S?
Yeah, probably anything from 75 to 150 above and beyond. As you can see, there are disadvantages. There's an additional return that's required. There's a corporate return filing. And then you got the cost of payroll tax compliance, which would be, quarterly payroll reports, annual W-2s. And whether you do that yourself or you pay a third-party provider, there is a cost to going through those hoops. So it depends on, where you're at now, where you think you're going to be in 3 to 5 years, whether you make that jump. I wouldn't tell you to jump into it right now with the tax reform, because a lot of the rules for the SCorp could be changing. So, yeah, but it is a model that we've had several of our realtors get into.
Kind of ballpark, what would it normally an annual cost to do those kind of things? Probably just the tax return.
Tax return could go anywhere from, a lot of that depends on the records that we get. So if you use an accounting software, which would be the next logical step if you incorporate, just to have a clean set of books, and whether you use a bookkeeper or you do that yourself, we don't have to make any adjustments. We're pretty much taking your numbers. It probably starts from $500 to $1,000. If we're having to go in and spend a lot of time cleaning up or putting all your transactions in, then it just goes up from there. And payroll can run. If you're the only employee, you could probably just do a quarterly payroll, just do one paycheck per quarter. A couple $100 for the quarterly returns and the annual filings, so maybe another $1,000 for annual payroll compliance. You can do it yourself pretty easily with like a QuickBooks program, where you pay for a payroll subscription. I think it's a couple $100 a year, and it's a lot of those returns are filed electronically through the program, and there's not a lot of manual work to be done with that. So yeah, it just depends. So like an example, so if you were making $100,000 net income as a proprietorship, your ordinary tax is going to be whatever it's going to be, but you're going to pay about 15 grand in self-employment tax. So if you carved it out under this SCorp model and took let's just say it's a $50,000 W-2 salary, essentially you're saving 15% on that delta between the 50 and the 100. So, $7,500 a year. Do that for 5 years, and it makes pretty good sense. Any questions on the SCorp? Again, you have an attorney draw up, the SCorp documents. You file a one-page form with the IRS, and get your payroll set up, and you're pretty well get a Fed ID number, and you're pretty much up and running under the SCorp model. And then I'll touch just on this. If you own any real estate that you're renting, if you're in that, you're kind of parlaying that into your real estate practice. The most typical entity that we see is like a multi-member LLC. So if you've got other investors that are partners, that would typically be the model that you utilize. It's very flexible. Again, it's a pass-through entity. I won't spend a lot of time on the multi-member LLC model. Tax deductions, again, just to reiterate the documentation. Certainly keep all your bank credit card statements. Mileage logs would be a big one in your industry. If there's one deduction that probably would get scrutinized the most under audit, it would probably be your vehicle expenses and your auto usage. And as we move into that, there's basically two methods you can account for your vehicles. You can use a actual cost or a standard mileage rate. So in an actual cost model, the business would buy a vehicle, you get depreciation for that vehicle, and the depreciation varies on the type of vehicle that you've got. You hear about the Hummer law, where people would go out and buy a large SUV on December 31st and get a huge write-down for that. Well, they're using the actual method. So essentially how that works is you would buy the vehicle, have the business pay for your fuel, your insurance, all your repairs, if you're financing, your interest, and then you still have to track your mileage because you only get to use your business percentage on that. So you still have to have a log of some sort to come up with your business percentage. And then you basically prorate your deductions accordingly to your business usage. The easier one and not necessarily cleaner, but it's just a standard mileage rate that the IRS allows for 2017 was 53.5 cents, typically ranges anywhere from 50 to, it's been as high as 56 cents a mile. That can apply to if you have, a couple of vehicles in your household and you don't want to deal with depreciation and tracking, you can just get one of the mileage log apps, and whichever vehicle you're using it, just track your miles, and at the end of the year, just multiply that times your business miles and take that as a deduction.
Just to jump in,
yeah.
Mile IQ is a good one. If anyone has it, you can export every month, and you can decide what, after a trip, you can classify it right then, whether it's business, personal, any other type of classification. It's really nice.
Yeah, like I said, the documentation on the mileage is critical as far as if you ever to get audited by the IRS.
Does that app start automatically when it knows you're moving, or do you have to start?
Yes.
No,
it's
automatic.
It is automatic, yeah.
All right.
And it's free.
I've tried it before, but I have not been able to.
It's free up until like 40 trips, I think. Then so you can get a subscription if you're going to have a lot more than 40 trips. But up to 40, it's free. So
It's just
40
trips a month. Sorry, up to 40 a month.
40 trips a month. In the car. Yeah.
So we put a few. What was the one that you mentioned, Rebecca?
Mile IQ.
Okay, so I think we have that one on there. There's a couple other ones. No, I don't track mileage, so I've never used any of them. But that's just the paper log books that everybody used to have in their glove box are a thing of the past anymore.
Is there one better practice than another when it comes to deducting mileage, if it's the standard method or whether it's going and buying a new vehicle? Like what's kind of the basis for that? Like, do I go buy a new vehicle this year and do all that, or do I just keep track of my miles?
Well, usually the biggest factor in whether you go to the actual method is depreciation. So let's say you're at the end of the year and your income's substantially higher than where you want it to be. Well, if you go out and buy a qualifying large vehicle like a Tahoe or a full-size truck where you can get the 179 deduction, you can get a $25,000 deduction in your purchase. If you're going to go out and buy a four-door sedan or something that doesn't qualify for that big write-off, then maybe you're better off just using the mileage rate. That's usually the kind of the rule of thumb when I'm talking to clients is what kind of a vehicle are you going to get? You can run some numbers to see which one may be more beneficial.
But if you go with the actual, don't you have to continue to use the actual method?
So you can start with the standard and go to actual, but you can't, once you start taking depreciation on that vehicle, you can't flip-flop and make it an actual. So once you've burned all that depreciation up,
You're stuck.
You're stuck until you get rid of that vehicle. And then you can decide with that new vehicle, how do I want to treat that? So yeah, generally you can't flip-flop year by year depending on what you want.
So over a period of say 3 years or 5 years, has anybody really punched out the numbers and said, well, this is actually the better way to go, or is it by price or by cost?
I'm guessing if you're going to keep the vehicle for 5 years, over that course of time, it's probably going to wash itself out. Like I said, the timing of the heavier deductions on the actual may front load that as far as tax benefit, and then toward the end. Now, if you're changing your cars every couple of years, then maybe the actual method probably makes more sense. But if you're going to keep it for a longer period, then at some point it's just going to get pretty close to washing itself out.
Okay. The vehicle does not have to be in the business name in order to be able to take actual expenses from a business site? It doesn't have to be in the business
I mean, if you're a proprietorship, no, it'd be in your personal name.
Then SCorp, it would need to be?
I'm sure I've got some that aren't. I mean, technically the business should own it if it's part of a corporate asset.
Mm-hmm.
Does it matter if it's a lease or whether you're buying it?
Lease would probably, yeah, not really, but you can't depreciate a lease vehicle. So instead of depreciation, you're gonna get a proration of your lease payments as you're going along. Or you could do the actual mileage on a lease and pay for all that stuff personally. So it would just look a little bit different than a purchase. It's gonna spread that deduction out, the lease in line with your lease payments. You're gonna do the actual cost on that. Any other questions about autos and vehicles? Again, it's probably I can't emphasize enough to have a good mileage log. If you ever, knock on wood, you never need it, but I guarantee if you did, that's probably one line they would start with on your return and take a look at. Meals and entertainment's another one that causes some grief for our clients. There's essentially, I guess, three tiers of deductibility for meals and entertainment items. There's zero. I mean, if it's you and your spouse going out and maybe you talk about your day, that doesn't qualify as a business meal. If you go out with a coworker and talk about, we've got some things in the works, sharing ideas, so you probably get 50% out of that. If you guys put on a class or any sort of promotion or educational event for the general public, and you either go to a restaurant, you host that, or you bring it in here and you provide Palmer's Deli lunch, typically you can get 100% deductibility for those items. Again, with the promotional, educational function, and then generally provided to the general public. So if you have any of those items, you just want to make sure your tax preparer knows to keep those separately to get that 100% deductibility on those. I won't touch a lot on travel, but there's per diems and all that kind of stuff. If you're going out of town, hotel, business purpose, if you're going to training, all that stuff, you can, depending on where your training is and how much of it's business related, whether you can deduct, airfares for a conference or something like that. If you're going to Vegas for 7 days and your conference is 1 day, you're not going to get full deductibility.
How do they go about doing that? I mean, how do they check on that? I mean, I have to.
In an audit?
So let's say you had 7 nights at a hotel. If you were at a conference and you had an agenda or some sort of materials provided by the seminar that showed you had classes for 7 days, then you're fine. If it shows, well, I had a 2-hour seminar at the Bellagio on one afternoon, but I was there for 7 days. I want to write off all my meals. Probably gonna be out of luck. Home office. This one gets a little bit tricky with realtors, and that's because of the primary place of business. So if you're hoteling at a location like this, but you're also using you've got a dedicated space in your home where you're doing the law says regulating exclusively as the principal place of business. It can get a little bit gray. How much time are you doing at which location and which one really is your principal place of business? Most of my realtor clients, we do take a home office on there. At the end of the day, it doesn't amount to a huge deduction, but like I said, there could be some scrutiny there. And there's basically 2 methods for the home office deduction. There's I got on the next slide here. The simplified method. So the actual method is going to be like the actual method on a vehicle. We're going to take a square footage of your dedicated office, your square footage of your home, and multiply that times your mortgage interest, real estate taxes, homeowner insurance, utilities, repairs, all that good stuff. Or there's a couple of years ago, they brought out the simplified method, which is a flat $5 per square foot, capped at 300 square feet. So flat $1,500 deduction, a little less record keeping type deduction to use on the home office.
Is that $1,500 a month or $1,500
for the year?
A year. Okay.
Yep. Annual cap.
It seems like the actual method would be equate to more.
Probably would. Then you've got probably subject to more scrutiny if the IRS were to come in and say, well, where's your dedicated office? Show me all your receipts for all your bills. Did you depreciate your house and if you saw it, you get recaptured? I mean, there's a lot of moving parts with the actual method that may not be worth the risk. But you're right, you're probably going to get a bigger bang for your buck on the actual method, depending on your circumstances. Questions on the home office? Other ones that we see in your industry, you know, split use items, your cell phone, home internet. Again, we typically take a business use percentage. There's always going to be some personal use of those devices. In most instances, maybe not all. Professional fees, you know, things. So if you do have a home office and you buy a new computer, a new desk, furniture for that office at home, you can certainly treat that as a qualifying business expense, further subject to expensing your depreciation. All your dues, licenses, continuing ed, marketing and client gifts. Technically, the IRS limitation is $25 per client per gift, which it's hard to find a gift that's $25 that you really want to give your clients for working with you.
Now, is that per, say it's a couple, per person or per couple?
I think they define the client would be the couple together. So technically, you could do a $25 gift for, well, I'm not exactly clear on that. I mean, whether you're going to go back and add up all your gifts and then subtract out the $25, it's probably a lower risk area. An exam, unless you're doing something pretty lavish for your clients. Just something to keep in mind.
So, I mean, is that per year? Say I have a client that has a closing and I buy them a closing gift, but then their birthday is 2 months later. Can I buy them a birthday gift?
I think it is per event. So you could do it twice under that circumstance. If you're paying inspection fees for your clients, obviously your bank credit card fees, insurance, postage, uniforms and clothing, not deductible unless it's something that you can't wear every day. So a military uniform, you're not going to wear out to dinner typically. Medical scrubs, dry cleaning is not deductible. We get that one a lot. But if you're buying a suit, jackets, all that stuff, you could, you know, go show a house, then go out to dinner in that same attire and not feel the need to change. You're not going to get a deduction for that, but we do get that question quite a bit.
Even if I have the logo?
Right, you can still wear that. You could probably treat that as more of a marketing type of expense. I would say if you're getting logo apparel, logo water bottles, all that logo stuff, I think you treat that more as a marketing. But if you're going to go out and just buy something, a jacket, that happens. So I'd probably file the logo stuff in an advertising bucket. Health insurance isn't a business deduction per se. It is a tax deduction. Essentially, for those that aren't incorporated, it's just a page 1 deduction. It doesn't go on your Schedule C. If you've got premiums that you're paying for that, HSAs are a good option if you're paying if you're on your own plan. It's a good way to tax some additional dollars on. You know, there's just different rules around the HSA as far as having to have a high deductible plan, but it's a decent strategy. If you get to the end of the year, you need some deductions to fund a couple grand to your HSA if you've got one. Questions on?
That's only if we are carrying our insurance versus our spouse that are carrying it through their company.
Right. Generally, if it's a spouse, most likely it's going to come out on a pre-tax basis through a medical reimbursement or cafeteria type plan. So yeah, if you're buying it solo or through the exchange, or I don't know what the option is going to be here coming up shortly for health insurance for self-employed people, there's just not going to be a lot of options with the everybody getting out of the game. Talk a little bit about retirement plans, options, again, mostly from the sole proprietorship viewpoint. You've got several different plans. Each has a little bit more, the plans that allow you to put more money in generally have more, compliance or administrative costs. That would probably be the 401k type of arrangement down at the bottom, where you just got to have, plan documents and that kind of thing set up ahead of time to do that. SEPs are usually fairly simple. It's just a percentage of your income. And you can do that through the due date of the return, so it's not something you have to fund before the end of the calendar year. You can just wait on, maybe cash flow will be better in April. I can fund that for the prior year. Same with your IRAs, again, traditional. Those are, you can set those up with a Fidelity or a Vanguard or whoever, and, do that through the April 15th date. Roth would be similar to a traditional IRA, but it wouldn't be deductible. So you'd have to run the numbers of, you want the deduction now versus tax-free growth of the Roth offer. There's a lot of different variety of retirement plan options out there for self-employed people. So if you're not taking advantage of something, it'd be certainly something to consider come tax time to help mitigate the tax thing.
What's the ratio? So you have the traditional IRA. What's the, you put $100 in or $1,000 in. How much does that offset your taxes ballpark?
So it's just like the health insurance. It's not going to bring down your business income. So it's not going to save you anything on self-employment tax. Then it becomes what tax bracket are you in? So if you're in 25% federal bracket and 9% Iowa's 35 cents on the dollar, it's going to vary, largely driven by your federal tax bracket. But again, a lot of them have the flexibility of not having to fund that before the end of the calendar year. Give you some leeway between the end of the year and your tax deadline as far as getting that deduction in after the end of the year. Reporting requirements, SCorp returns. If anybody's the one SCorp is, they move that date back to March 15th. You can extend that return out to September 15th if needed. 1040s, they've always been April 15th. They'll continue to be April 15th for the time being. SCorps, we don't see too many SCorps currently just because of the high rates, but as part of tax reform, they are proposing some lower rates for SCorps. I still don't think it's a great fit for what you all do. If you do have the SCorp and you do have payroll, like I mentioned, the quarterly filings that are due, annual federal employment, annual W-2s, but those are the compliance pieces that you'll have to add to your plate if you were to have an employee. And you can be a proprietor and still have an employee. You don't have to be an SCorp to necessarily have an employee. So if you have someone helping you out around the office and they meet the qualification as an employee, you can still be subject to these requirements.
You see the new rules coming out affecting those percentages, or?
No. I think the biggest question we see with employees is the employee independent contractor definition. So if you've got somebody working with you and you just want to give them a 1099 at the end of the year, but you have control of their schedule, you have control of what they're doing, you're providing them a place to work, they're probably going to fall under an employee threshold versus a 1099 independent contractor threshold. So that can raise some risk. Usually it's Iowa workforce development that's coming in and wanting to get their hands on some unemployment taxes. But as far as rates and stuff, not much there. 1099s, again, if you've got people that are working for you and you pay them over $600 a year, they should get a 1099. That doesn't include if you're buying supplies. If they're a corporate entity, you wouldn't have to issue them a 1099. It'd be more of a admin assistant type person that's helping you out directly, that you're giving them a cut of your business. So just keep those are due by the 31st to the recipient and 28th of February to the IRS. So and they have some pretty stiff penalties if you're required to file 1099 and you don't. So if you've got people that are doing some spot labor for you and they hit that $600 threshold, give them a W-9, get their information, then you can issue them a 1099 in January.
That right there, except law firms. So if I hire an attorney and I pay him $800, I have to 1099 him?
Yeah, I think the except law firms, yeah, they still need to get a 1099. Estimates, again, if you're self-employed, you're probably used to doing the quarterlies. And basically how they base those are, your prior tax liability is kind of your safe harbor. So if you hit a certain threshold, you have to do 100% of your tax, or 110% if you're at a certain gross income level. Now, if you know your income is going to be down considerably from where you were prior year, you can adjust those accordingly and still potentially not have any sort of underpayment penalty. But I know those are always fun, writing those checks every quarter to the IRS. Tax reform. Any questions before we move into tax reform? Just, it doesn't have to be anything on the slide, anything else in general.
Do you know what the penalty is if you don't pay it throughout the year, if you just do a lump sum?
It's an interest charge. I don't know what the rate is exactly, and depending on your level of tax, it's a percentage of that. So it's you're essentially paying interest to the IRS for not making those quarterly. So right now, this is as of last week, and I don't think there's been a lot of movement in it. I know the Senate is working on some things, but essentially we've got two separate bills, one in the House, one in the Senate. And I'm just going to highlight, I'm not going to highlight the whole thing, but I'm going to highlight things that I saw that is going to impact your industry specifically. With the SCorp, they're talking about, changing the game a little bit on. So one of the biggest premises that they both agree on is cutting the corporate tax rate. Well, that's a SCorp rate, which are your big publicly traded companies. But then they want to do something for the pass-through entities because there's so many more of those small businesses that are pass-through type. So they talked about having some sort of a cap on that pass-through income. So your SCorp may get capped at a 25% rate versus your ordinary rate if you're in a higher bracket. So that's one thing that might come out of that regarding the S corporations. Changes in the tax brackets. The House is going from 7 down to 4, and then the Senate bill calls for 4 or for 7 brackets like they have now. They've just changed it. They've raised the threshold for the 39.6 bracket, which would be the highest, up to $1 million instead of around 500 where it's at now. No real changes in long-term capital gains, which is good. So the things that really could cause some headaches in the real estate market are what they're doing to itemize deductions. Specifically, you hear about the SALT, which is the state tax deduction, but that also includes real estate taxes. So the House is proposing to cap the deduction at the first 10,000 of real estate taxes would be deductible. The Senate is looking to completely repeal all real estate tax deductions. So your customers, if they're considering that and buying a house, that might be off the plate. The other thing that kind of goes along with that is they've raised the itemized or the standard deduction threshold up to $24,000 for a joint filing company. So a lot of people that are currently itemizing and using mortgage interest and charitable deductions and real estate taxes may not even get to the point where they're itemizing going forward. So the pool, that middle class group, the tax benefits of home ownership are largely going to be either go away or be significantly reduced. The mortgage interest deduction, the House is basically saying that they're going to cap the amount of debt that qualifies. Currently, it's a little over $1 million. Now the mortgage interest is only going to be allowed on essentially the first $500,000 of mortgage interest that you pay. Anything above and beyond that is gone. Your traditional home equity loans where you go out and buy a car and you put on your home equity line and you deduct that interest, that's scheduled to be cut. And then also for those that have a lake home or a home in Colorado, that interest likely would be disallowed as well going forward. So a lot of things that certainly have an impact on what you all do. And I know in doing some of the research, I'm sure you're getting emails from your association saying, contact your legislator. These items are fairly unfavorable to your industry. Any feedback on that?
Go back to the state and local income tax deduction.
Mm-hmm.
So walk me through that, I guess.
So right now, the income tax that you pay to Iowa, you can take as an itemized deduction on your federal return.
Okay.
That would be going away under both scenarios.
And vice versa, right?
Federal and Iowa hasn't addressed anything.
Oh, I see.
On
Iowa's
this
not,
as of
okay,
yet,
I got you,
yeah.
I understand.
So, we really don't know what Iowa's doing. They've got plenty of budget problems on their own, so if they take away the federal deductibility on Iowa, they're gonna have to really reduce rates, because that's kind of how they argue to have such a high rate, is that they allow the federal tax deductibility. So I don't see Iowa doing anything drastic unless they complement that with an overall reduction in their tax rates. Like I said, so if you were traditionally itemizing and you had, $10,000 of state income tax that you paid, and you had $8,000 of real estate taxes, and let's say another $10,000 of mortgage interest that you were able to deduct, so that adds up to what I say, $28,000. Well, they're going to take potentially two of those buckets off the table. You'll be able to itemize and then be subject to that higher standard deduction. And the other catch is, I don't know if it's mentioned in the slide here or not, but they're also wanting to take the personal exemptions out of play. So in addition to your itemized deduction or your standard deduction, you get a deduction for yourself, your spouse, your kids. It's around $4,000 a piece. That's all gonna come out. So it's really what, at least my take is, it's kind of a shell game. We're moving all this stuff around in different form and fashion. At the end of the day, I don't know how it's gonna, I don't see any significant benefits. It's probably gonna hurt a lot of people in that $200,000 to $500,000 range is kind of what, just on initial analysis. So we'll see.
When I classify middle class now, what's the number for middle class?
I'm not sure how they define that when they're talking about tax cuts for the middle class. I'm not sure what thresholds they utilize. This is another interesting one. I mean, currently homeowners can exclude the sale of the gain on the sale of their house if they've lived in it 2 of the prior 5 years. They basically extended that, so you have to meet a 5 of 8 year residency test now. So people are gonna have to stay in their houses longer if they want to avoid that tax on the gain of their residence. You may have people moving less just because of the tax implications of doing so. And then, like the next bullet point there, the gain exclusion is only available once every 5 years, and currently it's every 2 years. And then there's also phase out. So they've really changed the game on the home sale taxable event, but it's still probably better than it was several years ago, and you essentially had to keep buying up to avoid gain on sales of your residence. And again, this is only on your primary residence, not on a second home or an investment type property.
And is all of this already passed? Or
No.
in
This
the
is
works?
all in the works. Everything from the tax reform all is the House is doing their thing, the Senate's doing their thing. We'll see how far apart they are, work out the kinks, and try to come up with something they can both agree on if they get enough votes.
Do you know an estimate of time as to when that should go into effect?
Most,
When they should have
almost,
finalized?
well, assuming they get something passed, I think everything I've seen is most everything is going to be effective for 2018. So what it does allow you to do is it's going to be a pretty, flip the switch January 1st, and you've got a whole new set of rules to work through. Whether they get the legislation signed, sealed, delivered by the end of the calendar year, I don't know. It could get pushed into 2018 and made retroactive back to January 1st, which is something they've done in the past. But yeah, it could leave a pretty substantial, a decent term of window where people think they're operating under one set of rules and have them kind of pulled out from under them retroactively. So, as I was going to say, I mean, the healthcare thing they kind of kicked around and really didn't get much traction on legislatively, but in the last 2 weeks, what we've seen on this tax reform is just they're steaming full bore ahead, and I think something's going to get done. If you would ask me a month ago, I would have said not a chance, but they're moving forward on it pretty quick. I don't know what the final. I don't really have a feel for what the final thing is going to look like, but I mean they're close enough on some of the mortgage interest things. The state and local stuff, I think they still got a little bit of a fight on their hands. But there's definitely going to be some changes. Yeah, just essentially we've got a few things to happen before it goes into play. Just some things, if we're going to assume that they changed the game in 2018 and you're not going to have a deduction for state income taxes or real estate taxes, you may want to accelerate those, make sure you make your fourth quarter state estimate in 2017 calendar year, don't wait till January 31st. Same thing, you can pay your March installment of real estate taxes in December. Make sure you get that deduction because that's cash basis, you can pay that ahead to get that on your 2017 return. If you don't think you're going to itemize next year and maybe you strategize around your charitable contributions to load those up in December as well to make sure you're getting the deductions for them. Assuming that in 2018, it's going to look a lot different. So just some things that we're telling people to go ahead and start planning on doing some of that now, especially on the state and local taxes, just because we think they're going to change pretty dramatically come the first of the year.
How much of an impact is when if you pay you pay an extra $1,000 on your property taxes in 2017 through March?
Mm-hmm.
Is that pretty significant to offset?
It's going to be your ordinary rates again, so through 25% bracket. But let's say you pay it in March and you're not itemizing your deductions. You jump up to the higher standard deduction, you lose your personal exemption, so maybe you're pretty close to where you may lose out of that deduction altogether when it's all said and done. Again, just some of the things that we've seen is your professional association is really not behind the reform. Again, I think they're going at it the wrong way, but who am I to say? It gives me job security, I guess, when they mix things up as dramatically as they're going to do. I think that's about the last slide I had on tax reform. Any questions on that specific topic? Yeah, I mean, I think, like I said, I think something will get done in what form or fashion. It'll probably be there'll be negotiations and compromise from now until then. Housing market, there'll probably be another interest rate hike in December, which obviously has an impact on what your customers are, the cost to acquire a home. So I would see, mortgage rates to follow suit at some point. Still relatively low at this point in time, but interest rates are going to continue that trend of gradually creeping up over the next couple of years, assuming that our growth is pretty solid. Locally, I mean, everything I've heard about the local market is, home values continue to rise. There's a insufficient level of inventory on the market, so houses are continuing to sell relatively quickly. Hopefully that's the way you guys see the market. And that's really all I have, other than any questions that you might have. I've given Becca the slide deck if you want to get a copy of that. She can probably email that out.
Yeah, I can get that. I'll put it in the drive.
Get it out to you. But, yeah, the tax reform is just the kind of the thing that we're dealing with the most right now at the office, just trying to figure out what it's going to look like and what kind of headaches it's going to bring to a lot of people. So.
Thank you.
Thank you.
Thank you.